presenter. Yeah, okay.
Okay. Before we start the seminar today, my name is Hendrik. Let me just give introduction to Phillip Nova. Today we have a seminar talk about spread trading. It's our part 2 topic on spread trading. Hopefully you'll watch the first video before you join the second one. If you haven't, it's fine. You still can watch back the part 1 video. Is it full screen?
I see the presenter view.
No, I can just. Yeah, so.
Yeah.
Right. Yes. Today I mentioned is talk about spread trading on a part 2. Before that, we will share about the company information. So disclaimer: whatever I'm sharing today is purely for educational purpose. It's not so much about trading core, right? So it's purely for education. So any question you can still ask us. We'll share just our opinion. Quickly share the company information in case you're not familiar. Phillip Capital is Phillip Nova is under Phillip Capital Group. So as a group, we are here for more than 50 years. Our HQ is from Singapore, and we have more than 15 countries operations, including the countries like US, the France, China, Australia, Japan, and so on. And we do offer different products across financial instrument like the futures, the forex, the commodities, the insurance, the investment and research, and so on. And Phillip Nova, so we are the subsidiary from Phillip Capital Group. So we are here in the industry for more than 40 years. The one thing different from us with our competitors is we are actually offering multi-asset trading, and mainly one key thing is we are offer on single ledger. So you use one account, one ledger, you can trade multi-asset products. For example, you can do stocks, ETF, futures, forex, CFD, everything under one account. And of course, we are regulated by MS. Like I mentioned, there are multi-asset trading products that's available on Nova. So quickly share, this is our Nova mobile platform. This is how it looks like. So if you look at the chart, it's powered by TradingView. Yep, so this is the interface. And we just launched Nova AI not long ago, I think a couple of months back. So it's basically if you have any questions about market, you can just ask over here, so that they'll prompt you the answers that you want. So you can ask what's the market about the knowledge about spread trading. What is spread trading? So they will actually provide you some of the explanation what is spread trading. So they will help with your trading. And also you can ask any about market. What's the earning? Like this example, what is the NVIDIA earnings? So you can get the information, and you can also revise the format if you want to. Next, we will share. This is the desktop application platform running on Windows. Again, the chart is powered by TradingView. So this is how it looks like. Again, like I mentioned, it's multi-asset trading. You can see from my watch list, there are different asset classes over here. There's futures, there's forex, stocks, CFD can be under one watch list. You can monitor multiple different products. And look at in the middle of the screen, there's a market depth. So it's a lot of our slightly more professional traders, they like to use this market depth tool to look at the depth of the market, the ladder. And you can also do the execution without confirmation. So this is a lot, like a one-click trading. And on the right, you can see the chart again is powered by TradingView. Yep. So today event is co-sponsored by CME. So today's topic we'll talk about CME as well. So we do have this promotion for a long time. So the micro suite product, we are charging 98 cents before exchange fee. So for example, there's the indexes, there's gold, crude oil, natural gas, copper, and the agricultural product. So this is the account opening in case you are, you want to open the account to get started on spread trading. Or any question you have, you can always drop us an email, or you can use this our WhatsApp number to contact us, ask any questions. So today we have the Pranay. He's from Min Finance. He's a senior research analyst from Min Finance. Has deep expertise in global macro focus on agriculture, metals, oil rigs, and FX and digital assets. I think without further ado, let's welcome Pranay to share about today's trading strategy. Thank you.
Thank you, Hendrik. So before we jump in, I'll just do a short intro to Mint Finance. So we're a Singapore-based boutique consulting and research firm. We provide advisory services covering asset and risk management, and we also consult in capital markets. Most of our clients include exchanges, hedge funds, family offices, sell-side brokers, and commodity market participants. We also publish research, which blends both fundamental, technical, and quantitative insights. Our investment strategies straddle multiple asset classes, and a lot of them are freely available in case you'd like to look at them further. The QR code here can also be scanned in case you want to access them. As I mentioned, research is the bedrock of our services portfolio. We publish for both institutional and retail investors. We also consult and educate. In education, we do webinars and seminars like the one today. Before we begin, I would like to go over a disclaimer. So the material that's been published here is for general education and circulation only, and advice should be sought from a financial advisor regarding the suitability of any investment or risk management product. Past performance is not indicative of future performance, and all examples that are used in this workshop are hypothetical and for explanation purposes only. With that out of the way, I'll start with an introduction to spread trading. Start with what are spreads and how are they traded. A lot of this, if you've attended the webinar, may be familiar, but for those who haven't, this will be a good time to catch up on what we covered during the webinar. So let's start with what spread trades are. Spread trades are essentially a combination of two different futures trade in the same position. So you can have multiple trades in the same overall position. They offer a relative value comparison between different derivatives. Those could be different expiries, different assets, and different grades of the same commodity. What does relative value mean? In one sentence, relative value means how does one leg of the trade, that means one of the trades, how does that perform relative to the other trade? Is it outperforming or is it underperforming? We look at both examples today, and hopefully after you've been through the example, it's a lot more clear for you. I'll start with one of the most famous spread trades that any spread traders might have seen, which is the gold-silver ratio. So as you can see, broad trends in gold and silver prices over the past 2 years show that both gold and silver prices have gone broadly higher over this period. Gold prices are up 77%, silver prices are up 176%. At the same time, the gold-silver ratio is actually down 35% over the same period. What that means is that spread movements are actually independent of the price directions in the underlying. That means the movements in the gold-silver ratio are not necessarily linked in which direction the gold and silver prices independently are moving. They're more a fundamental feature of how gold is performing relative to silver. In this case, silver has clearly outperformed gold, and that's the reason that you see that the gold-silver ratio has actually declined. An important aspect of spread trades is that spread movements can actually be uncorrelated even for correlated assets. So if you look at the correlation of gold and silver, in the bottom pane on this chart, that's the white line at the bottom. That shows that the correlation between gold and silver has been positive for the last 8 months. So from November to today, the correlation between gold and silver has been very close to strongly positive, and at worst, it's dropped to a weak positive correlation. That means that it's positively correlated during the entire period. At the same time, the blue line, which you see in the same pane, that's actually negatively correlated. That means that despite the fact that gold and silver are moving in tandem with each other, the gold-silver ratio is actually moving in the opposite direction. So the gold-silver ratio is declining during this period, when gold and silver are rising, the ratio itself is actually falling. That means spread movements are essentially uncorrelated, even for highly correlated assets. A brief overview of the categories of spread trades. So the first type, and the one that we'll be focusing most on today, are calendar spreads. These represent the same assets across different expiries. For example, you could open a position on both December and June natural gas futures. That would be a calendar spread trade on nat gas futures across both December and June. The way this trade would pay off is if December futures outperform or underperform June nat gas futures, depending on which side of the trade that you took. Another type of spread is an intercommodity spread. These are spreads across related but distinct assets. So think of the example we already saw, right? Gold and silver. They're both precious metals. They're both related, but they're still distinct. Different demand drivers for both of them. That's why you can see intercommodity spreads can be viable even if the assets themselves are correlated, they're similar, but not exactly the same. Another type of spread that you'll often see is across index spreads. These are spreads across equity indices compared to another different equity index. The most common one that you'll see is the spread between S&P 500 and the Nasdaq 100. So aside from this is across US markets, of course. Most commonly, the spread will provide you exposure to the broader US market versus how the technology stocks are performing. You can, of course, extend this to any number of indexes, right? It doesn't have to be S&P versus Nasdaq. It could also be S&P versus the Nikkei, for instance, right? If you feel that the US markets are going to outperform Japanese equity markets, it could be a spread between those. Another type of spread is a location spread. So these are across the same commodities across different delivery locations. For instance, WTI crude oil and Brent crude oil, both of those are crude oils, but they're delivered in different locations. And the spread here represents the premium between WTI versus Brent. Another type is a process spread. These are slightly more complicated, and they actually represent input and output relationships. For instance, oil is processed into gasoline, heating oil, for instance, among other commodities. That means the spread between them can actually be represented by a single quantity. Another type is a quality spread. This can be across different grades of the same commodity. This definitely doesn't cover all of them. There are other types of spreads, such as quanto spreads. These can be spreads across different indices, just denominated in different currencies. There could also be different types of calendar spreads expressed through options. And there can also be calendar spreads expressed through specific calendar spread contracts. With that, let's head into the advantages and challenges of trading spreads. So this section is basically going to cover when is spread trading actually viable and what are the risks. Let's start with the advantages. The first advantage is uncorrelated returns. So spread returns can actually be uncorrelated to the underlying asset returns, and these can offer diversification benefits. The clearest example is what we just saw. Gold and silver, both highly correlated quantities, but the spread itself is actually uncorrelated to the underlying asset. And if you have a position on the gold to silver ratio, that offers diversification benefits in your overall portfolio. Another advantage is that it provides a distinct payoff. The payoff profile and the driving factors for the spread trades are actually quite distinct from what an outright long/short position would perform or provide to a trader. That means if you have a more specific view, spread trades are the way to go. Another and one of the most important advantages is reduced margins. So margin requirements for spread trades are actually much lower than the margin requirements for outright trades. And we'll be exploring this in detail over the next few slides. But as I mentioned, this is one of the key advantages of why you would want to trade spreads in the first place. It's highly capital efficient. Another advantage is that spreads are actually mean reverting quantities. That means that when a spread heads in one direction, there's a high tendency that it'll mean revert back down. And that can offer better risk to reward ratios compared to outright trades during the late stages of the trades. So let's say you've missed the gold rally. You're maybe 2 years late to it. Going long against gold at this point may be risky. It might have a risk to reward ratio that's not in your benefit, but at the same time, the gold to silver ratio could still provide a positive and quite profitable risk to reward ratio for you. Another advantage is isolated exposure. It's less impacted by broader macro moves and much more impacted by what's happening in individual commodities. So it provides isolated exposure to the relative value itself. Finally, seasonality trends. This is something we'll be exploring in detail over the next few slides, but essentially spread trades can capture shifts in the curve structure, such as backwardation and contango, that are driven by seasonal trends, and traders can express view on the back of these commonly observed and quite consistent trends. That's not all though. There are risks to it. We'll be going over those in the slide. So the most common risk you'll see is spreading risk. So this is a risk where the correlation between the spread can actually break down, can cause the spread to widen or narrow unexpectedly. This can happen during supply shocks, for instance. When there's a supply shock, spreading risk is a major concern. Another type of risk is directional risk. So poor notional matching between the two legs of your trades could leave hidden exposure. That means you may be long gold, short silver, but the amount of gold that you're long may not match directly the amount of silver that you're short. And that overall, that would represent a net exposure in one direction or the other, which would mean indirectly you've inevitably gotten exposure to a long or short position, even if you didn't want it. Another type of risk is a currency risk. This is most common in cross-border spreads, where it can have FX exposure to your overall trades. So if you don't want FX exposure, you need to nullify it in the structure of the trade itself. Liquidity risk is when one leg may be much harder to trade than another. One common example you see here is the spread between natural gas that's traded in the US versus natural gas that's traded in Europe. So the Henry Hub contract versus the TTF contract. Henry Hub is far more liquid than TTF, and it can cause one leg of the trade to move a little more than the other and cause slippage when you're trying to both enter and exit the trade. Execution risk is where a delay in entering one of the legs can distort the pricing of where you were trying to enter. What we'll explore later on in this presentation is that execution risk can actually be mitigated quite significantly if you go through the Nova platform itself. Finally, there's tail risks. As I mentioned, extreme events can cause spreads to behave unpredictably. That can cause movements that go against the regime that you might have been observing. And that can cause movement that you weren't prepared for, and it can stop you out potentially. Let's dive a bit more in detail into calendar spreads and seasonality. Let's start with describing what calendar spread trading is and what are seasonal trends in the first place. So let's start with what is seasonality. Seasonality refers to the repeating performance in a commodity each year. That means that a commodity may perform similarly year on year, depending on which part of the year we're in. Generally, seasonality is driven by predictable supply and demand cycles. As we'll be exploring later, this can be driven by both supply side and demand side. So demand side, what we'll explore is natural gas. Supply side, one of the most common examples you'll see is actually agricultural commodities, which are actually highly supply-driven spreads. I would like to say, though, that seasonality is not a guarantee. Supply-demand shocks and shifting regimes, alongside general market noise, they can all lead you to performance that diverges from the seasonal trends that you may have been observing over the past few years. This is always a risk when you're trading spreads. Let's start with an example of where you might see seasonality, and one of the most common examples is natural gas. What I've plotted here is the 5-year average index performance in natural gas prices. This is the front month future over the past 5 years. You can see quite a few trends on this chart. Let's start with one of the key trends. Between March and June, natural gas prices over the past 5 years on average have trended higher. Generally, that's been driven by the fact that during the summer, natural gas demand is much higher. That's because during the summer, people turn on their ACs. As you all know, we're all in Singapore. It gets very hot. You need the AC, you turn it on. Somewhere out there, there's a natural gas plant that's burning more natural gas. As a result, they have to buy more natural gas, and that's what pushes the prices up. During late summer, though, producers tend to catch up, demand slows down, and that tends to push prices lower. So during June to July, you generally tend to see a drawback. And that's driven by the fact that supply at that point has exceeded the demand. Demand has slowed while supply has continued to rise. That doesn't last for long. Over the next few months, especially heading into winter, is when we see one of the largest legs of this trade. This is where natural gas prices rise significantly. They rise significantly heading into the winter because winter is one of the months where demand for natural gas is actually the highest. And that's because natural gas is used for heating. In Europe, for instance, if you go there, you need heating in your house, right? The way you do that is through natural gas. And in order to do that, you need to buy natural gas. That's what pushes prices up. In preparation for that, countries tend to stock natural gas. And that's why you see this trend starting to manifest a lot earlier than the actual demand kicks in. In the later part of the year, the same thing as the summers happens. Demand and supply start to diverge again. That's when supply has started to increase, but demand starts to drop off. Even though it's cold, it's still winter, supply has finally caught up. And that's why you tend to see a drop off in the later part of the year. Clearly, there are multiple drivers here. There are exogenous factors to consider, but both supply and demand are clearly driving performance in natural gas futures each year. As you can see, this chart is averaged out over the past 5 years. Despite that, we're seeing a pretty consistent trend. Let's make it a lot more methodical than that. Let's look at what happens in terms of monthly performance during these periods. The 2 months I would like to focus on are March and April. The reason is that those 2 months generally tend to have much more different performance criteria. Over the last 10 years in this case, so this analysis runs from 2015 to 2026. During this period, the average movement in front month natural gas prices has been about 2.2%. Nothing to scoff at. It's still rising. But compared to April, it's rising a lot less. During April, over the same period, averaged out, the average performance has been 6%. That's almost 3 times as much. Let's see how traders can actually execute something on the back of this, right? So this is one of our first interactive examples. It's a calendar spread on natural gas. This represents basically a position on the trend that we saw last time around. And this position is based in 2024. So it's a historical example. As I mentioned, historical trends do not necessarily guarantee that the same trend will occur this year. But I picked this time because it's clearly showing a trend and I want to use it to emphasize what is happening here. So during this period, you enter a position in both March and April expiries in natural gas futures. So you short the natural gas March contract. You do that at the price of 2.96697 on the 9th of Jan. About a month later, you close that position out. And you can see you actually make a loss on that. You make a profit on that position, right? So this was a short position. You saw prices fall. Clearly, it's profitable, right? You make a profit of 11,210. At the same time, you have another position running in parallel. You have a long position running in natural gas April futures. You enter that at 2.641 and you exit that at 1.646. Unfortunately, that makes a loss. You might think, what's the point of doing this, right? The point is that the net P&L from the spread is still positive. And the advantage here is not that one of your legs made a loss. It's that despite what happens directionally, which you may be uncertain about, you may not actually understand or be very certain about what's going to happen in terms of natural gas prices during Jan to Feb, but you may be a lot more certain about what's going to happen spread wise. In which case, this trade offers a much better risk to reward ratio. That's one of the key advantages. You can clearly see, even on the chart itself, right? Prior to when you enter this trade, the prices for both March and April futures had actually been rising. So at that point, it's easy to look back in history and say, it's clear at this time that you should have shorted it, right? It's very obvious. But if you look back, if you start on the 9th of Jan, it's not as clear. You don't know what's going to happen on the 9th of Jan over the next 1 month. That's where the uncertainty comes in. And the whole point of spread trades is to avoid that uncertainty as much as possible while still trying to trade profitably. That means over this period, you weren't sure whether nat gas prices were going to rise or if they were going to fall. Despite that, you knew that April would outperform March. So you took a position on that spread, and you can see that despite the fact that prices moved lower, the spread itself, which you can see in the top pane, actually ended up rising. It rose about 5%, and that made you quite a decent chunk of money at a far reduced amount of risk compared to if you had tried to take a directional long position. I would like to highlight something that's not as hypothetical. Let's look at what you might want to watch if you're a calendar spread trader in natural gas markets. One trend that's very interesting is the contrast between what happens in October versus what happens in December. During October, natural gas prices tend to rise, and they tend to rise pretty sharply. Over the last 10 years, the average increase has actually been 6.6%. By contrast, in December, prices have fallen by an average of 10.8%. Now, we looked at this on that line chart a few slides back, right? We know what the reasons behind this are. At the same time, we may not know where natural gas prices today are going to head. That means that in order to reduce risk, what you may want to consider is the fact that October to December spread tends to favor the fact that October prices are going to outperform December prices. So if you want to start your positioning, in October or in September, you may want to take a position on the fact that October is going to outperform December, even if you don't know that October prices are actually rising, right? You may not know that natural gas prices at that point are going to rise or not. Let's look at another trend. And this is where I want to introduce a slightly different family of trades. It's not something that I highlighted in my slide previously, but it's very interesting nevertheless. It's a form of calendar spreads, and it represents 3 legs instead of 2. Let's look at what happens between July, September, and December. Now, the key thing to consider here is the reason we're picking these 3 months, right? Why do we care about July, September, December specifically? The reason for that is that in September, the marketing year for US corn actually shifts. That means that's when US producers actually harvest their crop, and the new crop comes in. You start to get a lot more clarity on what that crop's amounts look like, what the yields were, exactly what the supply looks like. At the same time, you've probably been watching what the demand looks like as well, right? So when that new crop shifts into the old crop, what you can choose to do is express a position in a far more risk-reduced manner using something called a butterfly spread. This represents a position across 3 contracts, as I said, and the position essentially consists of a common position across July and December. So you could be long both July and September while being short September. At the same time, you can obviously take the other side of the trade as well. If you feel that the marketing year is going to overwhelm supply, if you feel that the next marketing year, the amount of crop that comes into the market is going to be very strong, you may want to take the other side of the trade. You may want to say that July and December prices are going to go down, but September prices are still going to go up. Let's look at an example of this particular spread. The spread is what you see in the top pane, and the three different contracts are what you see in the bottom pane. This particular example, again, is from 2024. It's not entirely cherry picking. I've picked this purely because I want to demonstrate historical performance of a particular butterfly spread. The most common butterfly spread actually is corn. When you talk to axe traders, you'll see that this is the one they like to really concentrate on. The corn crop has a lot of variability in terms of what the actual production is going to show. And that's why traders tend to focus on this. Over this period, what the entire position consists of is you're shorting the July contract. That means you're taking the opposite of the classical butterfly trade, right? You're going short the butterfly spread. So that means they're shorting July. You're closing the short about a month later. You make about $2,750 off that. At the same time, you are long September. You're long the month when the supply actually comes in. So in many ways, you can think of this leg as representing a hedge. You know the supply is going to come in. You know that supply is going to potentially push prices up. But at the same time, you know the supply is going to be lower than what you imagined it to be. That's why you're still long September, but it's more of a hedge. You do make a loss on this trade. You lose about $2,550. But at the same time, the last leg of the trade actually consists of the December short. This is a position where you short the December futures at the same time, because what you believe is that despite the fact that the crop, when it enters the market, may actually surprise expectations, you know that the demand side of it is still weak. You know that demand is still going to outshine anything that's happening on the supply front, even if September contracts may moderately move against you. And that's why you add this last leg of the trade, and this P&L adds to your overall tally. If we add all this together, right, you're making about $2,600 on this. Clearly, the advantage here is not just that you're getting risk reduction, but compared to a kind of classical calendar spread, this trade is actually much more profitable. Let's say by comparison, we took a position that was just short July, long September. The payoff for that trade would have just been $200, right? You see $2,750 on the July short. You see September contract paying out a loss of $2,550, only $200. By contrast, by converting this to a butterfly spread, you made far more money. At the same time, the exposure was very similar. The exposure was entirely based on the demand side of this market. It was not driven by anything external. It was not driven by the fact that December may surprise you, because this trade ran through June, you see. It didn't actually take place in December. So despite the fact that you're expressing a view on December futures, you're not waiting all the way to December. All you're waiting on is the fact that there's going to be ample supply. It's going to make you more money on the shorts than it's going to make you on the long delivery contract, which is September. That's when the supply comes in. That's the contract that all the producers are going to be delivering on. With that, I'd like to introduce you to a couple of platforms. The first one is CME Quick Strike. So CME Quick Strike actually offers advanced tools for traders, especially spread traders. Now, I'll quickly run through the slides, and then perhaps what I would like to do is also run through it as a live demo, because I think that would be very useful to actually show you how the platform works, how you may want to read it live instead of just theoretical, right? The few different sections of the platform that I'm going to be focusing on today are open interest buildup, term structure analysis, pace of the roll, and the spread builder section. Let's start with OI buildup. One of the most common charts you'll see is OI by expiry. This is from the Quick Strike tool. And here I'd like to just introduce that this is a free tool. You don't need to pay money to use it. All you need is a free CME account. If you have the free account, you can just access this platform. It's data that's openly available. The most important part is not the data, it's the fact that you can see visualizations like this. So let's see what this visualization actually is showing us, right? It's showing us on the blue lines, the blue bars, those are call options. The yellow bars, those are put options. Across all expiries, you can pretty much see a very common trend. The blue lines are generally larger than the yellow lines. That means that in general, across all expiries, this screenshot was taken last Wednesday. So it might be a little dated, but it's not going to be too far off. What you're seeing though, is that there are clearly more call options than put options overall. That's something that you can also see in one of the metrics right at the top, the OI put to call ratio. That put to call ratio says 0.58. Now, put to call ratios below 1 indicate that calls are outweighing the number of puts. That means there are more calls than there are puts. By contrast, if that ratio is more than 1, it means there are more puts than there are calls. Both of them are providing contrasting signals as to market sentiment. In this case, it's clearly positive, right? Calls far outweigh the number of puts by almost 2:1. But it's not the same across each expiry, right? If we look at OZZ6, that's all the way down there, right? You can see that the number of calls in the puts, there's still more calls, but they're a lot closer. There are almost as many puts as there are calls. By contrast, if we look at the contract that I have highlighted, OZCU6, that's the September contract in this case, that shows almost 3 times as many calls as puts. That means the number of call positioning on the September contracts is 3 times as bullish as what it is on the December contract. Almost, right? If we actually calculate the numbers, it's going to be more like 2x. But you can see the trend play out nevertheless. And if you kind of rewind a little, right, you'll clearly see why these 3 contracts are important. These 3 contracts are the contracts that you see play out in the butterfly spread, right? The front month contract, N6, U6, and Z6. That's July, September, December. These were the exact contracts that we saw. In this case, for this year, we clearly see that a lot of options participants are positioned very, very positively on the September contract. They're heavily long. There's a lot of call options. And you can clearly see that the amount by which call options outweigh put options is much larger. At the same time, one challenge with this tool always is that you don't know when that OI was built up. You don't know if that OI was built up yesterday, 5 months ago, or even 1 year ago. It could have come at any point, right? All you're seeing is a snapshot in time. You don't know when that OI buildup happened. And that's where CME's Quick Strike tool actually addresses that. They introduced this separate chart view called OI change. In this case, it's showing the OI change by expiry. So showing you how much OI changed between 26th of May and when this screenshot was taken, which was the 2nd of June, actually. So about a week, right? So showing you how much OI was actually built up over that week. And this shows you a slightly different picture. So if you see previous chart, this chart, it's not exactly the same, right? In fact, it's quite different. If you see Z5, in this case, Z5 sees a lot more put build up over this period. Despite the fact that overall, there's quite a lot of calls on the December contract overall, over this just 1 week period, we saw a lot more of a put build up. That means that despite the fact that overall options participants may have been bullish, over just this period, they were not. They were in fact bearish on the December contract. Similarly, the September contract didn't fare nearly as well as the overall OI picture would have showed you. The overall OI picture showed you almost 3 times as many calls as puts. The OI change picture only shows you 2 times as many calls as puts. Still positive, but not as positive as the overall picture would lead you to believe. The most interesting aspect, though, is the contract that you see below that, the Q6 contract, right? It's not a contract that had a lot of OI overall, but clearly a lot of OI was actually concentrated on this specific contract, and a lot of it was call OI. And that's important because it's showing you some diverging trends, right? People are still very bullish on corn in the near term, according to this chart. But at the same time, they're not as bullish post and during the harvest. So they expect a shortage in the near term, but they expect that shortage will ease after the harvest comes through. And well after the harvest, all the way in December, they expect that prices overall, supply demand, may be a lot more in balance. And that's where you may see these readings start to differ from the overall picture that you see. And it's always useful to check both views instead of just one. It's a more holistic picture, and it's something an advanced trader should definitely be looking at. Another type of view that you want to look at is the term structure view. So the term structure view is a section in QuickStrike which lets you see how the futures term structure for a particular commodity has changed over time. The one you see on left is the change in the corn term structure. The one you see on the right is the WTI crude oil term structure. The view that you see at the bottom is actually just a table view of the same charts at the top, right? So it's just the table view of the WTI term structure. You can copy it and you can export it to Excel and kind of do whatever you want with it. If you want to do more advanced analysis, for instance. What's more important here, though, is the fact that the term structure shift is actually telling you a lot. It's not just telling you how the term structure is shifted over some long-term period. It's also telling you how it's shifting over time. I think the most important commodity to consider here is crude oil, right? We've all seen crude oil has been heavily impacted by what's happening in the Middle East. There's a crisis, there's a supply shock that's impacting things very clearly. And that's the big blue arrow that's pointing upward is what's trying to suggest, right? So what we're doing here is we're comparing the term structure for WTI crude between the 4th of March to the blue line, which is the current term structure. You can clearly see that there's a lot more backwardation. Despite the fact that the overall term structure has shifted up, that means the prices for all contracts have gone up, right? They've gone up all the way up to the July 2027 contract. Clearly, you can see that happening on the right side of the chart here. That's not all that you see. What you see is also that backwardation itself is increasing. You see that there's a lot more premium for near-term contracts as compared to later contracts. So in this case, the backwardation has become far, far more severe compared to before. There's almost a $10 premium for near-term crude compared to if you wait 6 months from now. And that's what the supply shock is doing, right? It's restricting supply at the moment. Nevertheless, there's expectations that at some point in the future, supply is going to normalize. That's why there's a lot of premium if you want crude oil now. But if you're willing to wait half a year, 1 year, you can get a much cheaper price for it, right? You can buy that futures contract, you can take delivery 6 to 12 months from now, and you can save $10 compared to the current price. That's the backwardation shift that you're seeing. But it's not as clean, right? What you also see on top of this is the fact that backwardation has actually reduced compared to almost 2 weeks ago. 2 weeks ago, sentiment in crude oil has started to shift already. If you remember, in April, the sentiment started to reverse again, right? Expectations that things would normalize started to come about. People did no longer expected that the supply shock would be as severe. Both prices and the term structure shift reflect that, right? Prices are where most traders would go when they were trying to express a position on this. But the term structure shift provides a risk-reduced way to express the same type of view in a slightly different way. In this case, you don't actually have to short crude oil. If you talk to any trader who's tried to short crude oil over the past 2 months, they would tell you it's a very bad idea, right? It can rise 10% in a day. It can also fall 10% in a day. At the same time, the spread is not shifting as much. So if your view is the supply situation will normalize, what you can do is express a view on the term structure itself. That means that you can go short on the front month contracts and you can go long on the later month contracts. The risk to reward ratio for a trade like that is a lot better than an outright trade. And it's constantly shifting over time, right? It's not just unidirectional. Compared to 2 weeks ago, it's actually eased. And that's exactly the trade that I'm talking about, right? The sentiment easing. It doesn't just have to get worse. It can also ease, and traders can take take both sides of the view. They don't have to just pick one. Another section of the tool that's very useful is the spread builder. A common cross commodity spread that you'll see is the spread between crude oil and natural gas. You may ask, how are these two commodities connected, right? One is crude oil, it's oil that goes in our car. One is natural gas, the oil, the gas that goes into heating our homes or perhaps running some large scale generators. But actually, the supply side of this is a lot more common than you would expect. Natural gas and crude oil often come from the same source. So oil producers generally tend to also produce a lot of gas. That means that traders can again take a view on the spread between the two. When they expect that crude oil production is strong, but it's not necessarily meeting demand like it is right now. But at the same time, nat gas side of it is a lot easier. What they can do is they can take that view, right? They can put that into the spread builder tool and they can model how that's performed. In this case, though, the spread has actually gone in favor of crude oil, right? As I said, that's happening because the supply shock for crude oil is a lot more severe. There's a high amount of demand for crude oil. At the same time, while you're producing that crude oil, you get a lot of natural gas as a byproduct. That means the production, the amount of nat gas available in the market has gone up. As it's gone up, supply demand curves, as an econ major will tell you, right? They move opposite to each other. That means when the supply goes up, the price goes down. That's exactly what you see happening here. And the two lines that you see at the bottom, if you viewed them independently, you almost see no trend occurring. But the spread builder tool lets you see how the spread itself is performing. Instead of trying to figure out futures prices, trying to calculate it all manually, trying to plot it, the spread builder will do that for you automatically. All you need to do is pick two different types of commodities or even two different expiries, right? It also works with calendar spreads. And you can see how the performance has been. And you can also see how each of the individual legs has performed down below. One other very useful section for calendar spread traders is the pace of the roll. So this section of Quick Strike actually shows you when traders shift their positioning from one contract to the other. So when do they shift from the front month contract, the one that's expiring very soon, to the next contract that's expiring later, about 2 months from now, right? 1 month from now to 2 months from now. How do you know when traders are shifting from one contract to the other? You know that by looking at the pace of the roll. In this case, the pace of the roll is showing you the OI across one contract, the first front month contract, and then it's showing you the ratio between that to the other contract, which is the second month contract. As you can see, there's a pretty steep drop off around 8 days to expiry. After 8 days to expiry, most traders have started to shift, and they start to shift in an accelerating fashion, right? They start to go more and more towards second month contract. All their positions that are currently on front month, they start to transfer those positions into second month. You may ask, why does a spread trader care about this, right? They care about this because what you don't want is you don't want to be on a contract that's no longer liquid. So you don't want to be trading this contract 2 days from expiry when there's very little OI on the WTI front month contract. That will be risky. You'll get a lot wider bid-ask spreads. It's not going to be as favorable for you to enter and exit trades. At the same time, the second month contracts will become a lot more desirable. That's why you watch this. And something really, really useful that you see here actually is that the current pace of the roll has actually started to shift to second month a lot sooner than it generally does. So the averages are what you see in the gradients up above, right? But the yellow line, that's for this month. That's for how much OI has shifted from the June contract to, in this case, the August contract, which is the next primary contract. And you can see OI has started to shift much more quickly this time around than it usually does. All of that put together, you don't want to be in the June contract when there's no longer any liquidity, which means you want to preempt the roll. You want to be out of the June contract before the pace of the roll shows that most traders have already gone out of it. If you wait too long, it's always going to be a challenge. Let's now go into the Nova app. But perhaps something useful here is I'll just give you a short demo of how you can actually use the app itself. What we'll be covering today in brief is how to search for calendar spreads in the platform, how they're quoted, limit orders, order books, auto close off. We'll be covering all of that. But I think it'll be a lot more useful if we cover that through a live demo rather than just slides. Just give me a minute while I switch screens. Yeah. So what I've done on this page is this is the Nova desktop app, right? If you're a Phillip Nova customer, you can just go to the Phillip Nova website. You can download this app. You can access this. You can access this platform, and you can do the exact same thing that I'm doing. Let's start with how do you search for spreads, right? If you want to trade a spread, how do you find it? How do I express a view on it, right? The easiest way to search, let's say you're on your watch list mode. This is the first page that you will see when you open this platform, right? If you open this page, you go into product types, you see that spreads is a product type in itself. Within spreads, you can choose which exchange you want to look at. You want to look at CBOT, you want to look at CME, COMEX, Eurex, NYMX, all of them, right? Let's say I want to look at CME. In this case, I'm looking at CME. Actually, let's look at CBOT. CBOT may be more interesting because it'll let us see agricultural commodities. As we saw previously, agricultural commodities are some of the most interesting when you're looking for calendar spreads. Because of that supply demand curve, the way it changes around harvest season and the delivery season, it makes them very compelling for spread traders. So let's see how you'd look for an ags calendar spread. In this case, you just select CBOT. You select which contract you want to look at, right? Let's say I want to look at soybean oil. Open soybean oil. I can open the calendar spread category. Then I can also watch list. Otherwise, I can open them directly, right? If I double click it, it'll open it directly on the order mode on the side. If I decide if I just want to watch it, I want to see how it behaves over the next few days before I actually enter a position, you can instead watch list it and add it to your personal watch list. You double click it, as I said, you open the actual order view for it, at which point you can see the bid and the ask prices for the spread directly. These are not bid and asks for the individual contracts. These are actually the bid and asks for the spread itself. And what's really important here is that if you scroll down, right, if you go into order type, you can see that you can place limit orders here. This is something that addresses one of the key risks that spread traders face. One of the key risks is legging risk, right? You don't know when you'll enter one side of the trade and when the other side of the trade will activate. They could activate moments later, but during those moments, you're directionally exposed in the one leg that's active. That's something that traders generally want to avoid, right? Legging risk is major. Any active traders, anyone who's ever traded calendar spreads will tell you, you don't want your legging risk to eat into your profits because that's something that definitely happens. So in order to avoid that, you can place a limit order. That means that instead of it just executing at market prices, which of course you can do as well, you can just have both legs of the trade execute at once. You can also place a limit order. And the limit order actually lets you set the limit price. And this is very interesting because this is not something that an individual traders can do if they're not exposed to these spreads natively. If they don't have access to this sort of a view, what you have to do is you have to actually enter at market price all the time. That's the best case scenario for you, right? The best case is that you can enter both legs of the trade at the same time. But you can't at the same time choose what price of the spread you want to enter at. That's something that Phillip Nova allows you, and it allows you that using the limit price. So let's say we can clearly see, right? The chart mode shows up at the bottom. Again, very useful because opening this up separately in TradingView can be very tricky. You need separate subscriptions to data providers. Phillip Nova does this for you automatically. and instead of showing you the separate legs, it actually directly shows you what the spread is doing. In this case, we can see over the last 2 months, the spread between the July and the September contract has been favoring the July contract, favoring the September contract pretty consistently. That means the kind of premium that's available on the September contract relative to July has just been going up consistently, right? It was at almost 0% start of March. Now it's at minus 8.75. You see this trend appear and you say, it's dropping. I want to enter the spread, but I don't just want to enter it right now. I want to enter it. I see this trend occurring. I can open, of course, technical views. I can open indicators and I can find out, maybe I want to wait a little. I want it to drop a little bit further so I can perfect my entry. In which case, what you can do is just set the limit price to minus point, let's say minus 9 instead of minus 8.75. That means the trade will only execute when the spread actually falls to that level. If you think about replicating this using individual legs themselves, this is going to be almost impossible for you to do. Because the best thing you can do is place limit orders on each leg. But what that doesn't allow you to do is it doesn't let you know which leg is going to fall and which leg is going to rise. Either one may fall and either one may rise, right? You don't know which one is going to go up. You don't know which one is going to go down. All you know is relative value wise, the spread is going down. That means it could be happening because of either leg. It's not something you can replicate very easily using each of the individual legs. In this case, I can just select it and I can place that order based on a lower price than where it's currently at. And the spread will only execute when it actually drops to that level. Another useful thing is that you can see market depth. You see what other traders are doing. So you can see that a lot of traders today have actually been selling a bunch of calendar spread options on calendar spread futures on corn on these two specific expiries, of course. This is not across all expiries, but across July to September, they have been selling it. That means that they expect it to get worse, right? They expect that this spread is just going to decline further and further. If you see that happening, it's showing you trends. This is market data that you won't find externally. It's a very useful view for traders. See a bunch more sell volume compared to buy volume. It's a useful indicator. Same time, you can also see a bunch of buy volume at 9. You can see that there's a bunch of support potentially, right? So you don't maybe want to wait all the way till 9.5. You may only want to wait till 9, right? These are all conclusions that you can come to only once you see the spread appear here. The other thing I want to show you is something that's pretty interesting is the fact that you can do this not just for the full size contracts, but as Hendrik was describing earlier, right? Microcon contracts are actually very viable for retail traders. The margin requirements for these contracts are a lot lower than they are for the full size contracts. That means you need less capital deployments for the same exact view. At the same time, Nova doesn't discriminate, right? If you want a calendar spread in the micros, they'll let you have the calendar spread in the micros as well. So you can take that same July-September view on the micros instead of the full size contract. You don't necessarily need to go on the full size contract. One important thing that I want to show, right, is the kind of advantages that we see here. Something that actually will be easier if I just go back to the slide. One sec. Yeah. Oops. So give me a second while I just catch up. It gives you a review of the rest of the slides as well. Yeah, so searching we've already been through, right? You open the categories, you select spreads, you select the exact type of spread you want, and then from within that commodity or derivative, you can select calendar spread. That takes you to the view which lets you see which exact expiries you want that spread over. And then you can select that, you can wish list that, you can open that and place an order directly, right? Executing, as I mentioned, you can buy, sell. Yeah. So executing as well, we've been through, right? You can directly access the spread quotes with both market and limit orders. That's not something you can do with individual legs, and that removes the legging risk that you were exposed to. You can also access direct spread charts through TV. No need to manually input the spreads and intraday access. Intraday access for these commodities is generally restricted by TradingView, but if you go through Phillip Nova, that's not a challenge, right? You can see how it performs intraday as well. In this case, you can see the chart is showing every 5 minutes how the spread is performing. You don't need to just view the daily. You can view how it's performing very near term. Now let's look at what's happening with legging risk, right? This is a risk that I highlighted previously, which is what happens when one of the contracts expires, but the other contract in the spread trade is actually still active. Let's look at the two contracts on the right, Jan 2027, July 2026. Clearly, the July contract is going to expire in 26 June, which is about 20 days from now, right? The Jan 2027 contract, though, that's going to expire almost 6 months from now. That means if you naively entered this trade, you didn't track it, you just waited till all the contracts have expired, you would essentially have exposure to just the Jan 2027 contract all the way beyond 26th of June. That means the trade wouldn't automatically close. But the Nova platform fixes that. Last trading date for the spread.
Online see this one, the platform. Can you share this one?
Text. No.
This displaying this one.
I'll tell you what, I'll just go through just like this. Is that okay? Yeah. Sure. I'll zoom in so you can still see, but last trading day for the spread contract is actually the 26th of June, 2026. That means that whenever the first contract expires, the entire spread trade expires. You don't need to worry about when each contract is expiring. All you need to do is express that trade.
Sorry. Let me just swap
Yes,
the
yes.
webinar, yeah?
I see. This is what we're seeing. I understand. You can just switch to PPT, yeah.
Okay.
It's only 2 slides left, so I can just go through
okay.
it like this.
So this should be correct.
So yeah, as I was saying, right? Last trading day, it closes out that position by itself. You don't need to worry about when each contract is expiring. All you need to do is just express that way through the calendar spreads themselves. You don't need to have two separate legs to manage. It's not two different trades, it's the same trade. The second and perhaps the most useful reason to kind of do this, right, is margin offsets. This is a very, very compelling argument for traders, because for traders, what matters above all else is capital efficiency, which means how much return can you get off of deploying the same amount of capital. Let's say you have 1,000. In this case, let's say you have $2,500 to deploy. How many contracts can you buy with it, right? How much upside do you have? Let's say the two contracts on the right. Initial margin for the Jan 2027 contract and the July 2026 contract are both $4,100 almost. Add those two together, you need $8,200 of margin to be able to express that trade. But of course, through calendar spreads, you don't need to worry about that because the exchange itself is offering you offsets. In this case, the initial margin, if you go directly for the spread trade, is just $2,000, which means it's just 1/4 of if you had tried to go through individual legs. That's one of the key benefits, right? If you wanted to express the view, you were still getting that $700 of profit. But in order to get $700 of profit, you no longer had to deploy $8,000, $9,000 in margin. You only had to deploy $2,000. If you convert that into return on capital employed, right? It's a lot better than the picture might tell you just in raw numbers. And for traders, that's what really matters, right? You can always buy multiple contracts of the same thing. What really matters is how much capital are you putting at risk. In this case, calendar spreads can reduce that drastically. And exchanges offer this generally because these two contracts are correlated. They're able to offset the risk from one contract to the other. They recognize that and they pass on those margin reductions to you. It's them being less greedy, right? It's them offering some of those upsides to you as a trader. Similarly, let's see what happens with the butterfly spread. So this is the other type of spread, and it's where this shines even further, right? In this case, if you went for the full size contract, July, September, December, if you try to express the view on all of them, you would have to pay $3,600 in margin. If you went directly for the butterfly spread, you would just have to pay $600 in margin. That's a lot better. It's like 1/6 instead of just 1/3 that we saw previously, right? 1/4. So it gets even better because in this case, again, the correlation, the view that you're expressing is a lot more focused. It's a lot more focused on what's going to happen when the producers in the US, when do they start delivering those corn crops, and what happens to corn prices exactly then. If you have a view on that, you can directly use the butterfly spread, and you don't need to worry about separately margining each contract, right? That's one of the key benefits. With that, maybe I'll go back just to quickly reiterate because I just realized we skipped how to cover butterfly spreads. And this is interesting, as I mentioned, butterfly spreads, they can clearly offer a lot better benefits in terms of margin, right? So butterfly spreads, you'll see them pop up with this square bracket FLY code at the start. If you want, you can also search for that code. Once you find it, you can open it up, you can wishlist it. Then you can directly access the butterfly spread instead of trying to go through individual legs or individual calendar spreads. Directly, it takes you to the butterfly spread. And as we saw previously, the advantage here is that the margin benefits, the exact view that you're expressing is so much more focused than before. It's no longer about just the fact that one contract is going to outperform another contract. It's more so about what the harvest season is actually going to provide to us. So with that, I think we can just head back to the slides, quickly review what our recap is showing us and open up for questions. So one of the key takeaways from this webinar, and again, these are a lot more of these can be found in detail on our webinar that we did a few weeks ago. So if you want details on calendar spreads, into commodity spreads, into cross-index spreads, you can find a lot more of those examples covered in the webinar. Today, we've mostly focused on calendar spreads. If you're interested in the other categories, you can, of course, go through the link. You can view the recording of the webinar, and you can view what we covered for the other families of spreads. So essentially, spread trading is focusing on relative value. Your profits are coming from the price relationship between contracts. So whether they are outperforming or underperforming, and not outright direction. If we go back to the start, right? If we go back to what gold and silver were showing us, it doesn't matter whether gold and silver prices are rallying or falling. What really matters is whether silver is outperforming gold or whether gold is outperforming silver. Your view becomes a lot more different. It's no longer about whether precious metals as a whole are going to rise. It's a lot more about which precious metal is going to rise more. There are multiple categories of spreads. There are calendar spreads, into commodity spreads, cross-index spreads, and each of them offers distinct opportunities and risks. As I mentioned, if you're interested in some of the other families of spread trades, please do go through our webinar. That's, again, it's available as a recording. So you just have to play it on YouTube, right? It's not going to be difficult. You can view some of the examples that we covered there as well as a detailed discussion on mean reversion. Finally, risk is reduced but not eliminated for calendar spreads. So while spread trades do carry lower risk than outright trades, investors are exposed to new types of risks. There are spreading risks and legging risks. These are not risks that outright traders face, but it's something that spread traders are uniquely exposed to. And the most important thing here is being aware of them, being prepared for them, being sure that you understand where these risks are stemming from, the fact that one position may outweigh the other, the fact that you may have one side of the position that's more active for longer than the other side of it. Both of those risks you have to be very, very aware, right? When you're a spread trader, it's reducing risk, it's not eliminating it, it's introducing new types of risks. With that, we come to an end, and there's a few research articles. Again, these are all available in TradingView if you would like to read them. You can scan the QR code, and I'll open the floor to any questions that you may have at this point, and I'd be happy to clear them.
Any questions?
You can backtest it both through the seasonality indicator that I showed on TradingView, right? If I go back a bit, you'll see that view pop up. One sec. This view, right? So this is just the seasonality indicator. If you go in TradingView, you search for seasonality among the indicators. It'll let you see how the front month contract has performed in each month. Giving you a rough picture. This is not exact because it's not telling you how each contract has actually performed. For that, what you'll want to do is actually open up individual contracts. This is a view where it becomes slightly more complicated, but not too much, because you can open, let's say you want to observe the relationship between the June and the September contract specifically. What you can do is you can open the June and the September contracts.
But it's not integrated in the Phillip Nova app.
Yeah, you can see it just you can see it historically, right? You can see how it. One sec. So you can see historically how specific spread has performed. At the same time, you can also open historical ones. So it's much quicker if you go this way. You don't need to open each individual one by itself. It's just one spread that you have to click on. It opens this view up for you. But you will need to look at each individual spread over past years, like separately. Yeah, yeah.
So we've got a question online.
Yeah.
So yes, it's asking, is there a best time window to enter into spread in order to capture the seasonality trend?
Right, right. So in terms of upside, what you generally want to focus on is the fact that some of the seasonality spread, seasonality performances that you see on the slide, right? A lot of them are driven by what's happening front month. So front month performance is a lot more stronger. It's a lot more pronounced. That's why if you have a very focused view in, let's say, what's going to happen in the summer, if you feel summer demand is going to be a lot stronger, what you generally want to do timing wise when entering a spread like this is wait until one of the legs becomes a front month contract instead of entering months before. You can, of course, do you can enter it earlier, right? You can enter the March, April spread at any time before that. The challenge is your profits are going to be capped. They're going to be a lot lower than if you waited until the contract became the active month. Active month contracts tend to be a lot more volatile. At the same time, that offers opportunities for traders, right? That's where your alpha is coming from. So if you wait till it's a front month contract, it can sometimes be the best. At the same time, another metric to look at is mean reversion. So if a spread has moved vastly in a different direction, if you've seen one of the expiries just completely outperforming all later expiries, and you believe there's not much of a fundamental reason behind it, then you can wait for mean reversion to start to play out. For that, you can watch technical indicators like moving average crossovers, things like that. You can view when the trend starts to reverse. But at the same time, as I said, what you need to really focus on is the fact that you need to be sure what's happening on the fundamental side. We saw with crude oil, right? It's not as simple as just the backwardation has gotten severe, so I'm going to short it. It's not that simple. You need to know why that backwardation has gotten severe. In this case, for crude oil, the backwardation got more severe because of a supply shock. If you see the supply shock easing, if you see it kind of normalizing over the next few months, that's when you want to take that trade. And to find out when the right time to enter it, you could watch technical indicators like moving averages.
Any other questions for our speaker today? Any questions? Yes, sir.
Yes. You mentioned the reduction into the margins.
Yeah.
You know? So that's of course when two futures are listed on the same exchange.
Yeah, yeah.
Is there any other way to reduce this margin if we're talking about same underlying but two different futures on two different exchanges?
So no, unfortunately, it's mostly the exchange that's offering that margin reduction. So if it's across exchanges, you may think that it's the same concept, but because it's the exchange offering it, in this case, the exchange is not in charge of both legs of the trade, so they can't offset that in the clearing side of it. So it has to be the same exchange.
Just very good question. Yeah, so there's the workaround. So for example, if you talk about WTI crude oil, right? Yeah, so this WTI crude oil on NYMEX. The Brent crude is on ICE, but there's a Brent crude financial on NYMEX. So the correlation between NYMEX, Brent, and the Brent crude financial is a lot closer. So that's the workaround. You can do this spread when you get the margin reduction. But of course, it's really different exchange like a DCE iron ore or DCE palm oil and the palm oil in Malaysia. So there's no any reduction. Yep. Any other questions for today? So I think part of the reason why we want this topic, we want to go beyond just outright. I think for those who are not familiar with spread yet, I think a lot of us we learn about outright trading first to understand trend, to trade on the trends. But what we observe is a lot of professional traders, they trade more on the spread. So hopefully with that, we also invited Mr. Pranay with the CME to educate our customers. Hopefully we can also learn beyond what's only on the outright. Maybe it's a lot to take in today. Today is part 2, in case you missed out the part 1. And today one will be recorded as well. You can go back and watch back the part 1 and part 2. So when you have any questions, you can feel free to reach out to us. And when you are ready to trade, like I think he showed on the platform, it's available. We do have some arrangement. So if you want closer to exchange margin, we can still adjust lower from the current margin from the platform. So that's number 1. Number 2, we do cater for professional traders as well. So if you are looking to do inter-commodity spread, like he mentioned, gold and silver, right? On current platform, we may not be able to get the reduction from the Nova. We do have platform like CQG that so on the platform that they will recognize is a inter-commodity spread. So the moment you place the spread on the platform, you get the margin reduction already. So we do have the solution for you if you're looking to trade any kind of spread. Then it's available. Even you are more advanced trader, you are looking for algo trading, we do support as well. We do have API and we do have platform can support algo trading as well. Yep. So feel free to reach out if you have any questions. So we do cater for different kind of customer, the mass retail, the high net worth, the professional traders. We do support as well. Yep. Any other questions for Mr. Pranya today? Just in case you don't know, he flew in from India, right, for the seminar today. Let's thank him for his support to Phillip Nova and CME. Thank you. Yep, I think if that's all, if no more questions, we will end the session for today. Thank you so much for your time. But if you have offline any question, you can feel free to just talk to us. Thank you. Thanks. Let me see how to end. Mute.